So let's start with trading. When someone is trading, they are in the markets for the advantage of the price movements and the sentiments of the market. Value is not that of a relevance when you're trading because it's normally short term. Now there are three primary ways that people trade in market. One is intraday trading, two is swing trading, and three is positional trading. Intraday trading is when someone buys or sells the security or trade within the day, within few hours or even few minutes. At the same time, swing trading is a little longer position wherein you hold in for couple of days, at least 3, 4, 5, 6 days. And positional trading is when you hold your position over a month, maybe 2, 3 months. Now, there is a fact in the market that only 1 to 2% of the traders actually end up making money year on year basis. 98% of the people lose money to the 2% of people in trading. Why is that? That is because trading has a lot of moving parts, or in other words, variables. Because for a successful trader, one needs to have a very strong trading system. 2, they need to have a very resilient emotional conditioning. And 3, they need to be extremely disciplined. Apart from that, you need to be hardworking. Why I say so? You need to have a very strong system is because if you see year on year, the volatility in trading has only increased. There was a time when the Nifty or the indexes used to move barely some few points, 20, 30, 40 points. Today, we see that the index moves 100, 150 points within seconds. Now, because of this volatility, your decisions and your readings have to be readjusted in order for a trade to be successful. And it is a known fact, the more decisions you are given to make, the more the decisions could be wrong. Because humans cannot consistently make right decisions. Because there are emotions which get involved. Imagine you have bought and secure trade as of now, which was long. And the market goes down by 50 points within few minutes. Emotionally, it will create a lot of anxiety and fear in you. At the same time, when you have a trade which is moving in your direction, the greed will keep hunting you to keep on trailing it more and more without planning for risk or taking a proper exit. To overcome these emotions, we have algorithms and formulas. The formula and algos are made from the basic principal rules of trading. For example, it's either based on the price movement or the derivative indicators like Bollinger Bands, moving averages, volume. All of these factors come together to give you a buy or sell signal, and you instruct the algorithm to buy it or sell it when a particular event occurs. But there is a flaw. All algos are not successful because algos are primarily tested on a back-end data. And for an algo to work perfectly in the live market, it needs to be experimented on a very accurate set of data. Because if the data is corrupted or is not of good quality, it may result into wrong results, which when go to live market may turn out to be devastating. Similarly, even if you have the data and algorithm right, the algorithm does not cover a lot of events that may happen in the market. For example, the algorithm did not cover the event when North Korea test fired a missile in the Pacific Ocean and the US retaliated with conflictive speeches. For example, when North Korea launched test fire missiles in the Pacific Ocean, it drew criticism from United States, which resulted in correction in markets. Now, such events are not accounted while you make an algorithm, and such flash crashes can cause huge amount of losses, which may wipe away all your previous profits, or at the same time even cause you loss on a yearly basis. So trading algos is difficult. Moving on, emotions are a very integral part of trading because in a short duration, you may go through multiple emotions of joy, excitement, greed, and at other times you may see fear, anxiety and pain due to loss, because the market is of such nature, and when the money is involved, it is natural for your emotions to play an active role in your decision making. Apart from the markets, other emotions like having a fight with someone at house, having some major loss in your life, or some other event may also affect your emotions, which will impact your decisions and it may affect your trades. So emotions is something that one needs to control before they become a trader. The third thing that we'll have to understand is it's a very lonely and hard-working job because markets never sleep. Literally, this is not because the live market is not on weekends, but it's also because the flow of information is never ending. It may be Saturday or Sunday. There are events happening all over the world 24/7. You might have noticed that the world markets are on in Indian time from 6:30 a.m. in the morning, starting with Asian markets, going to Indian markets till the afternoon and ends with American markets at almost midnight. So it's a never ending journey. If you are someone who can build that discipline, have a lot of control over your psychology and emotions, can trade with systems, and at the same time you can keep on working hard consistently for days together, then trading is something you should seriously consider doing. Why I say so? That despite having these drawbacks and challenges, trading could be rewarding because it uses leverage. Trading in most of the part of the exchanges is done via instruments like futures and options, which provide you leverage. So for example, if you want to buy a stock that is costing 100 rupees, you may only need to pay 20 rupees in order to take that position. But when the stock gains, you may gain on the entire 100 and not on the 20. So your return, where it could be 10% on 100 rupees, when it's a leverage position, the same return could be 24 to 25%. But there is another drawback to this, that when with a leverage position, if your profits are maximized, so are your losses. And believe me, when you're in losses at a leverage position, your emotions are so high and it could be really dangerous, wiping out almost your entire capital. So risk management is something that a trader deals with on day-to-day basis. It's a never-ending challenge because risk can occur from any part of the world or from anything. For example, there's a political risk, there's a country risk, there's a market risk, there's a company risk in which you are trading. All these factors need to be managed because if you can manage risk, the reward will automatically come. And so when you can do all of these things, you are someone who can become a trader because at the end of the day, due to leverage positions, you can maximize your returns. Now, trading can be used to either create cash flows because in investment, when you invest for a long term, you don't have regular cash flows to meet your expenses. But it's highly recommended not to use trading as your primary medium for your day-to-day expenses because see, markets are volatile. If your daily life is affected, your emotions will be affected with it, and that will affect your trades, which may cause more losses. Another interesting fact about trading is that you have to be comfortable with taking loss. The best traders in world have a hit rate of 60 to 65%. That means out of every 10 trades they make, they lose 4 trades and win 6 trades. That's the best kind of winning rate that you will get. Most of us, I have 3 to 4 winning trades and 5 to 6 losing trades, which keep our capital at bay. So despite all of these challenges, I would recommend anyone wanting to venture into trading needs to go under intensive trading, not only on technical analysis front, but also in terms of your psychology, your understanding of the markets, your lifestyle. A lot of preparation has to be done.